Hedge funds just dumped silver at a pace we have not seen in over 2 years. And while they were running for the exits, one of the most respected economists in the world dropped a warning that should terrify every person holding cash right now. Inflation is about to hit 10%, not 5%, not 7%, 10%. The kind of inflation that destroys retirement accounts. The kind that turns your savings into toilet paper. The kind that has only happened 3 times in the last century. And every single time it happened, silver did not just go up. It went absolutely vertical. In the 1970s, silver went up 25 times. In 2021, it nearly tripled. And right now, the same exact setup is forming again, but here is where it gets terrifying. At the exact same time that smart money fled precious metals, the data shows something unprecedented. Hedge fund positioning just hit a 25-month low. The last time they were this underweight, gold was trading at $2,000. Today, it is at $4,800. They are going to have to buy back everything they sold. And when they do, silver is not going up 10%. It is going to explode. The 10% endgame has just been triggered and almost nobody sees it coming. Stay with me for the next few minutes because what I am about to show you could be the most important financial information you hear all year. Welcome to the Unseen Economy. If you are new here, smash that subscribe button because I drop videos like this every single day. Now, let me show you why silver is gone and what the 10% endgame means for your wealth. Let me start with the inflation warning that should have been front page news but was completely buried. Peter Schiff just released an analysis that made my blood run cold. He pointed out that despite the March producer price index rising less than expected, it still rose 0.5% in a single month. Year over year, producer prices are up 4%, which is the biggest gain in more than 3 years. And this is where it gets alarming. Schiff says that in 2026, the PPI will rise more than the 6.2% jump we saw in 2022. And it may surpass the 10% surge we saw in 2021. Let me make sure you understand what this means. The Producer Price Index measures inflation at the wholesale level. It measures what businesses pay for raw materials, for energy, for labor, for transportation, for everything that goes into making the products you buy. It is the leading indicator of consumer inflation. Because when producer prices spike, those costs get passed on to consumers within 3 to 6 months. There's nowhere else for those costs to go. So when Peter Schiff says PPI could hit 10%, he is not making a wild prediction. He is reading the data that is already in front of us. He is telling you that consumer inflation is about to explode. He is telling you that the cost of everything you buy, from groceries to gas to rent to healthcare to electricity to clothing, is about to surge higher than anything we saw during the worst of the post-COVID inflation crisis. And here is what nobody in the mainstream media is connecting. The Iran war has disrupted global oil supply chains. The Strait of Hormuz disruption has sent energy prices through the roof. And energy is the input cost that affects every single product in the economy. When oil goes up, transportation costs go up. When transportation costs go up, everything goes up. This is supply-side inflation, the kind of inflation that central banks cannot fight with interest rate hikes. The kind of inflation that feeds on itself as businesses raise prices to protect their margins. The kind of inflation that destroys the purchasing power of every dollar in your bank account. And what happened to silver during the last inflation spike? It nearly tripled from its COVID lows, but this time could be even more explosive. And I will show you exactly why in a moment. If you are connecting the dots, drop a comment and tell me what you think happens to silver when inflation hits 10%. Now, let me show you the second piece of evidence that confirms the endgame is here. The US dollar index just collapsed below 98. Now, that number might not mean much to you, so let me put it in context. Last week, the dollar was trading above 100. It had rallied on safe haven flows as the Iran war escalated. Everyone was piling into dollars thinking it was the safest place to park their money during the crisis. But look at what just happened. The dollar crashed from above 100 to below 98 in a matter of days. That is a massive move in currency markets. And here is the kicker that Peter Schiff pointed out. The dollar is now at its lowest level since March 1st, when the war began. That means the dollar has already lost all of its safe haven gains. Every single penny that flowed into dollars for safety has now flowed back out. Think about what this tells you about market psychology. Investors tried to hide in dollars during the crisis. They thought the dollar was safe, and now they are abandoning it. They are realizing that the dollar is not safe at all. They are realizing that with inflation heading toward 10%, holding dollars is a guaranteed way to lose purchasing power. And when people lose faith in the dollar, where do they go? They go to hard assets. They go to things that cannot be printed by central banks. They go to gold. And especially, they go to silver. If you are loving this breakdown, hit that like button right now. It helps more people understand what is really happening in the financial system. If you're loving this breakdown, hit that like button right now. It helps more people understand what is really happening in the financial system. Now, let me show you something that will blow your mind. This is the data that proves silver has disappeared from the system. The Kobe letter just reported that we are witnessing a historic short squeeze in the stock market. The S&P 500 has added nearly $6 trillion in market cap since March 30th. $6 trillion in less than 2 weeks. That is more value created in 2 weeks than the entire GDP of Japan. But here's the part that almost nobody is talking about. In just 5 trading days, hedge fund short exposure to US ETFs went from the highest level since May 2025 to lower than 97% of all cases over the last 5 years. Let me say that again because this is absolutely insane. Hedge funds went from maximum short exposure to almost zero short exposure in 5 trading days. That is not normal repositioning. That is not a gradual shift in sentiment. That is panic. That is forced liquidation. That is a historic short squeeze that forced funds to cover their positions at any price just to survive. The Kobe letter specifically called this a historic short squeeze, not a rally, not a recovery, a squeeze, the kind of violent move that destroys traders who are on the wrong side. And where did all that money go? According to the Kobe letter, the capital that was sidelined during the Iran war is quickly rotating back into AI stocks. Nvidia and Apple were trading at nearly half the valuation of Costco and Walmart after the correction. So money flooded back into tech. They also noted that 4% inflation is back, and investors are searching for any source of yield as a hedge. That is a direct quote. Investors are searching for yield hedges because they know inflation is about to eat their returns alive. But here is what nobody is connecting, and this is the key insight that could make you a fortune. While $6 trillion was flooding into stocks, precious metals positioning collapsed to multi-year lows. Ola Hansen, the head of commodity strategy at Saxo Bank, just reported that hedge fund net long gold futures positions hit a 25-month low in the week ending April 7th. A 25-month low. That is the lowest positioning since early 2024. And here is the mind-blowing part. The last time hedge fund positioning was this light, gold was trading near $2,000 an ounce. Today, gold is trading near $4,800 an ounce. That means hedge funds have almost the same exposure to gold now as they did when gold was less than half the current price. Do you understand what this means for silver? Silver follows gold, but silver amplifies gold. When hedge funds start rebuilding their precious metals positions, silver does not go up 1%. For every 1% gold goes up, silver goes up 2%, 3%, or sometimes even more. And right now, hedge funds have abandoned precious metals at a historic pace. Silver is gone from their portfolios. The positioning is at rock bottom. What happens when they come back? Take a look at the chart that tells you exactly when this move is going to happen. Look at this chart of gold with Fibonacci retracement levels. Gold hit an all-time high of 5,596 in late January. Then came the Iran war, the liquidity crisis, the margin calls, and gold crashed all the way down to $4,180 on March 23rd. That was a $2,500 correction, one of the sharpest drops in gold history. But look at what happened next. Gold bounced perfectly off the 200-day moving average. It has been climbing steadily ever since, and now it is approaching a critical level that could trigger the next explosive move higher. The 50% Fibonacci retracement sits at $4,047. Ola Hansen at Saxo Bank specifically identified this level as the key resistance. He said a sustained break above $4,150 would likely trigger renewed momentum and systematic buying from trend-following strategies. In plain English, when gold breaks above 4,850, the algorithms start buying, the trend followers start buying, the momentum chasers start buying, and the price accelerates higher. And when gold breaks out, what happens to silver? Silver explodes. Let me show you what silver has already done. After bottoming near $61 on March 23rd, silver has climbed back toward $80. That is a 30% recovery in less than a month. But here's the thing. Hansen says silver is still in a rebuilding phase. The March liquidity shock exposed how sensitive silver is to shifts in macro conditions. The recovery is notable, but further gains are needed before confidence is fully restored. Put simply, silver has started moving, but it has not broken out yet. You're still early. The big move is still ahead. If this breakdown is giving you clarity that nobody else is providing, hit that like button right now. It helps this message reach people who desperately need to see it. And stay tuned because we connect the final dots. The 10% inflation endgame, the dollar collapse, the historic short squeeze, and exactly why silver is about to go vertical while almost nobody is positioned. Now let me tell you why this time could be different from any previous silver rally. Why the 10% endgame could create the most explosive silver move in history. Look at this chart showing gold versus the Bloomberg Dollar Index. When the dollar weakens, gold strengthens. The correlation is almost perfect over the past 18 months. Every major dollar decline has corresponded with a gold rally. Every major dollar rally has corresponded with gold weakness. And right now, the dollar is weakening rapidly after losing all its safe haven gains. Peter Schiff pointed this out specifically. The dollar gave back everything it gained during the war. That is a major shift in market psychology. Now look at this chart showing gold versus US 10-year yields inverted. When yields fall, gold rises. This correlation has also been nearly perfect. Rising yields crush gold because bonds become more attractive. Falling yields support gold because bonds become less attractive. And right now, Fed funds futures are pricing in rate cuts. The market is betting that the Federal Reserve will have to cut rates to prevent an economic crash. Lower rates mean lower yields. Lower yields mean higher gold. Higher gold means explosive silver. This is not speculation. This is the correlation that is held for years playing out in real time. Now pay very close attention to this next part. Look at this chart showing Fed funds futures. The current Fed funds rate has already dropped from 4.5% to around 3.75%. That is 75 basis points of cuts already done. The Fed has already started easing because the economy is weakening, and the futures market is pricing in rates around 4% for December 2026 and December 2027. That means the market expects the Fed to hold rates low. There is no expectation of rate hikes anywhere in the futures curve. None. Why does this matter so much for silver? Because silver thrives in low rate environments. When rates are high, people get paid to hold cash. They put money in treasury bills and earn 5% risk-free. Why would anyone hold silver, which pays no yield, when they can get 5% guaranteed? But when rates fall, that calculation changes completely. When rates drop to 3% or lower, holding cash becomes painful because inflation is eating your purchasing power faster than your interest is accumulating. When rates are low, investors are forced to look for alternatives. They look for assets that protect purchasing power. They look for hard assets that cannot be printed by central banks. They look for silver. And we are entering a period where the Federal Reserve has no choice but to keep rates low. The economy is slowing rapidly. Consumer confidence just collapsed to an all-time low. The Iran war has disrupted global supply chains in ways that will take years to repair. Businesses are struggling with higher input costs and weaker demand. The housing market is frozen because nobody with a 3% mortgage wants to sell and buy at 7%. The Fed is trapped. They cannot raise rates without crashing the economy, but they cannot keep rates low without letting inflation run hot. And inflation is about to spike from the supply side, not the demand side. This is the Fed's nightmare scenario. They cannot fight supply-side inflation by raising rates. Raising rates does not create more oil. Raising rates does not reopen the Strait of Hormuz. Raising rates does not fix broken supply chains. All they can do is watch as prices spiral higher while keeping rates low enough to prevent a total economic collapse. This is the nightmare scenario for the dollar and the dream scenario for silver. Now, let me tell you why I called this video the 10% Endgame. Throughout history, there have been 3 periods when inflation spiked into double digits in America. The 1940s during World War II, the 1970s during the oil crisis, and 2021 during the COVID supply chain crisis. In every single one of those periods, precious metals exploded higher. In the 1970s, silver went from under $2 to over $50. That is a 25 times increase. People who bought silver at $2 and sold at $50 turned $10,000 into $250,000. That is life-changing money from a single trade. In 2021, silver went from under $12 to almost $30. That is a 2.5 times increase in less than a year. And now we're heading into another double-digit inflation period. But this time, the setup is even more extreme. In the 1970s, there was no massive short position to squeeze. The COMEX barely existed. The futures market was tiny compared to today. When silver rallied, there were no leveraged shorts getting margin called and forced to buy at any price. Today, the COMEX is dominated by paper traders who have been shorting silver for years. Bullion banks hold massive short positions that they roll over month after month. When silver starts moving, these shorts have to cover. And when they cover, they have to buy. And when they buy, the price goes higher. And when the price goes higher, more shorts get squeezed. It is a feedback loop that can send prices parabolic. In 2021, hedge funds were heavily long precious metals going into the inflation spike. They saw it coming, they were positioned, so when prices rallied, there was plenty of selling to absorb the buying. Today, hedge fund positioning is at a 25-month low. The longs have been flushed out. There's no one left to sell. Ola Hansen at Saxo Bank specifically said that lean positioning reduces the risk of further long liquidation and creates scope for renewed buying. In previous cycles, central banks had room to raise rates aggressively to fight inflation. Volcker raised rates to 20% in the early 80s to crush inflation. The Fed raised rates aggressively in 2022 and 2023 to fight post-COVID inflation. Today, the Federal Reserve has already started cutting rates because the economy cannot handle higher borrowing costs. They cut 75 basis points already. They cannot raise rates again without crashing the housing market, the stock market, and the banking system. They are trapped. Every single factor that matters for silver is more bullish today than it was during previous inflation spikes. The short positioning is more extreme. The hedge fund underweight is more extreme. The central bank constraints are more extreme. The supply chain disruptions are more extreme. This is not just another inflation trade. This is the endgame. The final phase of a monetary system that has been building toward crisis for decades. And silver is the asset that benefits most when the endgame arrives. Now, let me be clear about something. I'm not telling you to go out and bet everything on silver tomorrow. I am not a financial advisor. I'm just someone who looks at data and tries to understand what it means. But here's what I can tell you. Every single piece of data I showed you today points in the same direction. Inflation heading toward 10%, dollar collapsing, hedge funds at 25-month lows, gold approaching breakout, silver already recovering, but still early. The setup is there. The evidence is there. The 10% endgame has been triggered. What you do with this information is entirely up to you. But I want to leave you with one final thought about what happens when silver moves. Silver is not like other assets. When silver moves, it moves fast. When silver breaks out, it does not grind higher like the S&P 500. It explodes. It gaps. It leaves people behind who are waiting for a pullback that never comes. In the 1970s, silver went from $6 to $50 in less than 2 years. In 2020, silver went from $12 to $30 in less than 6 months. In 2025, silver went from $24 to over $100 before the March correction brought it back to $61. These are not normal returns. These are life-changing returns. The kind of returns that turn small positions into down payments on houses. The kind of returns that turn modest retirement accounts into generational wealth. The kind of returns that separate people who understood what was happening from people who were watching from the sidelines. And every single time the big move happened when nobody was positioned for it. Every single time hedge funds were underweight. Every single time retail investors had given up after a painful correction. Every single time the mainstream media said precious metals were dead, or that gold was a barbarous relic, or that silver was just an industrial metal. Just like today. Hedge funds at 25-month lows, retail investors burned by the $1,500 gold correction, and the 30% silver crash in March. Mainstream media completely focused on the AI stock rally and ignoring precious metals entirely. Nobody talking about silver on the financial news channels. Nobody recommending silver in the investment newsletters. That is when it happens. That is when the big moves come. When nobody's watching. When nobody's positioned. When everyone has given up. When the last bull has thrown in the towel. The 10% endgame has been triggered. Peter Schiff is warning about double-digit inflation. The dollar has lost all its safe haven gains. Silver has disappeared from institutional portfolios. The positioning data shows hedge funds at multi-year lows. And somewhere out there are people who see this data, who understand what it means, who remember what happened the last time inflation hit 10%, and who are quietly positioning themselves for what comes next. The question is whether you will be one of them, whether you will see this data and take action, or whether you will watch from the sidelines as the 10% endgame plays out and silver makes its next historic move. Drop a comment and tell me where you think silver goes by the end of 2026. I read every single comment and I want to know your price target. And if this video opened your eyes to what is really happening with silver and inflation right now, smash that like button and share it with someone who needs to see this data before the endgame plays out. This has been The Unseen Economy. I will see you in the next one.